So welcome back guys. In this session we'll be doing all the problems related to application of the marginal costing in short term decision making. So illustration things and the theoretical part we had covered. Now we are left out with the MCQs. So practical MCQs and the other comparison questions we'll be covering it today in this session. So we'll right away get started. So question number 1. So what are they telling? PQR Limited manufactures a single product and it sells for 40 rupees. Selling price is 40. Fixed cost is 60 rupees, 60,000 per year, and the contribution to sales, which means the PV ratio. PV ratio is 40%. Fixed cost is 60,000, and they are asking out to find out break even in units. Simple. What is the formula for break even in units? Fixed cost divided by contribution per unit. Okay, so first, do we have contribution per unit? No, but can we find it out? Yes. So contribution per unit is nothing but SP into PV ratio. So here it will be SP is 40 into 40%, which means 16. So just divide the fixed cost, which is 60,000, divided by 16. You will get the answer. 60,000 divided by 16. It is 3750. Simple. So they are asked to find out the BEP in units. So we can find out the other way around also. We have the PV ratio, we have the fixed cost. We will get the BEP in amount 60,000 divided by 0.4. We will get 1,50,000 divided by the selling price, which is 40. We will get 3750. So either of the ways, the answer is 3750. Understood? Next we will go to the second question. So second question is also we have to find the PV ratio. We have the fixed cost, we have the break even point. Just find out the PV ratio. Very simple. So the formula will be same, but we have to interchange the variables. That's it. Please find it out. Question number 2. So the formula for BEP is fixed cost by PV ratio. Here we have BEP 1,60,000. We have fixed cost which is 48,000, but we don't have the PV ratio. So cross multiply. It means 48,000 divided by 1,60,000 into 100 will be our PV ratio, which means 48,000 divided by 1,60,000 is 30%. So if you divide 48,000 divided by 30, you will get the same answer. So the answer is 30%. C is our answer as per the calculation. So simple. The formula for BEP is fixed cost by PV ratio. Interchange the variables. That's all. Please try the third one. Product A generates a contribution to sales ratio, which means PV ratio is 40% here. Fixed cost directly attributable to product A amounted to 60,000. Sales revenue required to achieve a profit of 15,000. So this question is based on desired sales. What is the formula? Desired profit plus fixed cost divided by PV ratio. So it will be desired profit is 15,000, cost is 60, total will be 75 divided by 40%. So 75 divided by 40%, which is 1,87,500. Simple. All simple questions. Please try. Please read the fourth one. So fourth question is that XYZ Limited makes a special gadget for the car it manufactures. The machine for the gadget works out to full capacity and income 15 lakhs and 40 lakhs respectively for variable and fixed cost. Okay, if all the gadgets were purchased from an outside supplier, the machine could be used to produce other items which could earn a contribution of 25. What is the maximum price that XYZ should be willing to pay to outside supplier for the gadgets, assuming that there is no change in fixed cost? That is the question. So maximum how much it can pay? It can pay maximum variable cost because fixed cost will not take into consideration for decision making. So maximum should pay variable cost. But sometimes we will be losing contribution. No? That also we should cover. So that's the reason we have to maximum ask for variable cost plus lost contribution, which means 15 plus 25. So 40 lakh is the answer here. Because 15 lakh is variable cost, that you have to ask, then the last contribution. That's it. Please go to the fifth question. Fifth question is easy. Z Products Limited manufactures 4 products E, F, G, H using the same raw material. The input requirements for EFGH are 1 kg, 2 kg, 5 kg and 7 kg. Product wise selling price and variable cost they have given. We will get the contribution. So divide that contribution by the requirements, that is 1, 2, 5 and 7. You will get the contribution per kg. Then rank it. That is the question here. Please solve it. I will give 2 minutes. First find the contribution, then divide the contribution by the input kgs, which is 1, 2, 5 and 7. You will get the contribution per kg. Then rank it. So we'll solve it here. Fifth question. Particulars EFGH. Sale price 100, 150, 200, 300, 125, 100, 125, 100, 70, 50. So 50, 80, 100, 175. So kgs 1, 2, 5 and 7. So 1 to 5 and 7. So divide it, guys. So it will be 50 here, 40 here, 20 here. 175 divided by 7 is 25. So I'll give rank 1, rank 2, rank 3, rank 4. So the order should be E, F, H and G. E, F, H and G. So option P. Please copy this. Simple question. So next we'll go to the sixth question. So sixth question, X Limited has 1000 units of absolute items which are carried in the inventory at a original price of 50,000, which means cost. These items are reworked for 20,000, so total 70,000, and can be sold at only 36,000. Alternatively, they can be sold at a scrap of 6,000. In decision making model used to analyze the reworking proposal, the opportunity cost is nothing but the scrap value, 6,000. Simple. That opportunity cost is large because we cannot sell it as a scrap if we are reworking on it. No, that is the thing. So next, the sales and profit for the firm for the year 21 is 1,50,000 and 20,000. 22 is 1,70,000 and 25. PV ratio. I'll give the hint: change in profit by change in sales. Find the answer. I'll give you just 1 minute. Change in profit by change in sales. I'll get the PV ratio. So what is the change in profit? 25 minus 20 divided by 1,70,000 minus 1,50,000. So it is 5, it is 20, just 25%. Simple. Change in profit by change in sales. That is the thing. So 8th question is a bit tricky. Please analyze. The company has a break-even point when sales is 3,20,000, which means no profit, no loss, and a variable cost at this level of sales are 2 lakh. So my contribution is 1,20,000, but at this point break even, which means no profit, no loss. So whatever the contribution, that will be the fixed cost. How much contribution? How much would contribution margin increase or decrease if the variable expenses are dropped by 30,000? So if the variable expense is dropped by 30,000, what is the increase in the PV ratio percentages? For that we have to prepare income statement at first. Question number 8. Okay, so sales minus variable cost minus fixed cost minus variable cost minus fixed cost will get the profit. At this moment we have the sales of 3,20,000 minus variable cost is 2,00,000. So my contribution is, this is contribution. Contribution is 1,20,000. So at BP profit will be 0. So my fixed cost is 1,20,000. So this is my actual position now. Okay, now they are telling that how much contribution margin will increase or decrease if the variable expenses are dropped by 30,000. So first I'll calculate the PV ratio here. PV ratio is 1,20,000 divided by 3,20,000. How much is that? So it's 1,20,000 divided by 3,20,000, it is 37.5. Okay, now variable cost is dropped, they are telling that. So my sales will be same. Variable cost is dropped by 30, which means 1,70,000. Here it will be 1,50,000. So anyhow this will be 30,000 is my profit. So now they are asking only the contribution margin. So that's why I'll calculate the PV ratio here also. 1,50,000 divided by 3,20,000 into 100 will be 1,50,000 divided by 3,20,000, which means plus it is 46.875. So the difference between the old PV ratio and the new PV ratio is 30 minus 37, 9.375. The PV ratio has increased. So do we have the option? The variable contribution margin means PV ratio is increased by 9.375. So done. So we have an existing position, we have to find out the new position. Then what is the difference? What has increased? Here the contribution margin has increased by 9.375. So that is done. Please copy this. Next, we'll go to the next question. Question number 9. Make or buy decision. A radio manufacturer finds that it costs 16.25 per unit to make a component. The same is available in the market at 5.75. Continuous supply is also assured. Breakup cost is as follows. Materials 2.75, labor 1.75, fixed other variable cost 0.5, and depreciation other fees 1.25. Okay, the best option for the manufacturer. If you see the question only, it will tell that we have to buy, because where is, I think this one is 6.25, I guess. Okay, please take it as 6.25, not 16. How can you compare 16 with 5.75? It's not possible. Better to buy. Okay, because it is less cost. If you buy and they are given continuous supply assurance also, then why we should make extra expenses? We'll buy it from outside only. Next important question. So if you remember, we had did this question in December 21, a purely competitive market. We have the same question in marginal costing also. Please make a note. We have done one complete question in this. In a purely competitive market, 10,000 pocket transistors can be manufactured and sold, and certain amount of profit is generated. It is estimated that 2.0 pocket transistors need to be manufactured and sold in a monopoly market. Monopoly means there is no competitor. Example, Indian Railway. Profit under both the conditions is targeted at 2 lakh. They want a profit of 2 lakh. That's great. The variable cost per transistor is 100 and the fixed cost is 37. So fixed cost we can't change at any level of production. Now variable cost is 100 and unit selling price we have to calculate for monopoly. What is the unit sold in monopoly? So it is estimated to, so this is not 2.2 actually, this is 2000 transistors, 2000 pocket transistors. Okay, so 2000 units into 100, which means 2 lakh again. 2 lakh, it is 4 lakh 37. So 4 lakh 37 divided by 2000, it will be 218.5. I solved this because same question will be doing in the marginal costing. So it is already covered. If you're seeing this video first, it will be first time for you. If you're seeing marginal costing and then coming here, this will be second time. Same question. Next, Mr. Mahesh has a sum of 3 lakh invested in a business. He wishes for a return of 15% in return, which means how much is he expecting? 3 lakh into 15% is 45,000 he is telling. Okay, he wants a return of 45. It is revealed that from the present cost data analysis that the variable cost of operation is 60% of sales. Fixed cost is 1 lakh 50. On the basis of information, you are required to find out the volume, sales volume, to earn a return of 15%. This is desired sales. We have the profit, we have the fixed cost, we have the variable cost. So the difference between the variable cost and the sales price is contribution. Divide it, we'll get the number of units. Simple, please calculate. I have given you the profit. We have the fixed cost. Using the variable cost, we can find out the PV ratio and find out the sales volume. So I'll help you out here. So desired sales, the formula is desired profit plus fixed cost divided by PV ratio. So desired profit is 45,000, fixed cost is 1 lakh 50 divided by PV ratio. PV ratio is 1 minus VC. 1 minus 0.6 is 0.4 here. If you divide, you'll get 11. 4, so 45,000 plus 1 plus 1 lakh 50, 1 lakh 95 divided by 0.4 is 487 500. Simple and done. See, same question number 12 and question number 9 are both are same. See, we'll check what they are asking here. A radio manufacturer finds out that it costs 6.25 to make a component M140 and same is available in the market of 5.75. Okay, continuous supply is also assured. The breakdown cost is as follows: material 2.75, labor 1.75, variable cost 0.5, depreciation and other fixed cost 1.25. We have to deduct it because we are not concerned with the fixed cost here. What would be your decision if the supplier has offered the component at 4.25? Anyhow, we will go with the supplier only. Buy. Because as it already it is less. Over and above that, they are telling that you will give at 4.85. Done. So, 13th question, please read it. So, continue or shut down. That concept. Very simple question. Sorry. So they have given fixed expenses at 50%, 15,000. Fixed expenses when the factory is closed down is extra 10,000. Additional expenses for shutting down 1,000. Production 5,000. Contribution. So we will lose the contribution. We have to check everything. So we have to make two scenarios, one if you are running and one if you are not running. If you are running, you will have only fixed cost. If you are not running, we will have fixed expense, that is 10,000. When the factory is closed down, we will have the additional expenses of shutting down, what is 1,000, and the loss of contribution. All the three things. Then we make a comparison which is feasible. Go with the decision. We'll try it out. Session number 13. Continue, shut down. We'll just note on the expenses. So if you are continuing, you'll have fixed cost of 15,000. If you are shutting down, you'll have a fixed cost of 10,000. Extra fixed cost of 1,000 and loss of contribution, which is 5,000 into 1 if you are shutting down. So here we have 15,000, here we have 16,000. Now tell me which is good, running the business or closing the business? Obviously running the business. Okay, simple, please note it down. So sometimes continuing the business is good rather than shutting down. So example, if you take the scenario of COVID, if any businesses shut down in COVID, they could not come back. If someone tried to hold down the business in COVID, now they are making more profits. Example, hotel industry. Now we have the last MCQ. After that, we'll be doing the comprehensive problems. A company manufactures and sells three types of product A, B, C. Sales 80,000, which it is distributed in 50-30-20 ratio. Make a table, particulars A, B, C. Then take 80,000, divide it in the ratio 50-30-20. Then variable cost is 60-50-40. So we have the sales. Take the variable cost, that is 60% of. If you take 80%, 80,000 for A, it is 50%. So which means 40,000. Out of 40,000, 60% is variable cost, which means 40% is your contribution. Then we have to find the combined PV ratio. That's all. So So first find the sales, then divide the variable cost based on the sales. Then add all the contribution, divide by total sales, that is 80,000 into 100, you will get the combined PV ratio. Please try it out. Now we'll go to the 14th one. Sales, it is in the ratio of 50, 30, 20 of 80,000. 50% is 40,000. This is 24. This is 16. A, B and C. Done. Okay, now VC is important. They're telling 60, 50, 40. So 40,000 into 60% is 24, which means 16 is my contribution. Understood? Now that 50%, which means 12,000 here. 12. Then we have 40%, which means 16,000 into 40% is 6,400. 6,400. 16,000 minus 6,400 is 9,600. Just a second. So it is 9,600. We'll add all the contribution to find out the combined PV ratio. So 16 plus 12 is 28 plus 9,600, which is 37,600 divided by sales is 80. You'll get the combined PV ratio. 47% is your answer. Simple. Answer is C, if you can see. So please copy the simple problem. So just we have to calculate the combined contribution. That's it. So by this we have completed all the MCQs. Now we will start with the comprehensive problems. First question is very simple. So you have to find the PV ratio. So they have given 2-year sales, 2-year profit, which means you can obviously calculate PV ratio. Once we have PV ratio, we can build the income statement. What is income statement here? Sales minus variable cost minus fixed cost, you'll get the profit. Once you build that, you have the fixed cost, you have the PV ratio, you can find out the BEP. Next, you have the sales to earn a required profit of 40,000. So desired sales. So what is the formula? Desired sales, desired profit plus fixed cost by PV ratio. Next, we have to find the margin of safety at the profit of 50,000. We have the profit, we have the PV ratio, which is calculated before. We can find it out. Variable cost for 2 periods. If you build the income statement, then variable cost is there only. So please calculate everything. So these type of questions can be expected, we can expect in examination. Please try it out. Please try in the class itself, because it is one first time revision and this question is also very simple. So question number 1. So PV ratio change in profit by change in sales. So it is 25 minus 20 divided by 1,70,000 minus 1,50,000. So which means 5,000 divided by 20,000 into 100, which means 25%. So done. PV ratio. Next, BEP. So before that, we'll have a working note here, which is income statement. So I have my sales. So contribution we can find it by PV ratio, fixed cost and profit. So we'll take the first scenario 2021. So my sales is 1,50,000. Okay, my profit is 20,000. Here they have made a mistake. Okay, so it should have been here, it should have been 21, 22, and here it should have been sales, profit. Please change this. Okay, you'll be confused. So this format is wrong here. So they have interchanged. Okay, so my PV ratio is 25%, which means my contribution is 1,50,000 into 0.25, which is 37,500. Okay, and profit is 20, which means The fixed cost is 17,500. Accepted. So you can check for 2022 also. You'll get the same thing. So 2022, my sales is 1,70,000 into 0.25 contribution. I'll deduct 17,500 of my fixed cost. I'll get 25,000 as profit. So I have the PV ratio, I have the fixed cost. So then I can calculate BEP. BEP is fixed cost by PV ratio. So 17,500 divided by 0.25. 17,500 divided by 0.25 is 70,000. This is my BEP. Next we have to find the desired sales. So desired sales, the formula is desired profit plus the fixed cost. We'll get the desired contribution. If you divide the desired contribution by PV ratio, obviously we'll get the desired sales. Simple. Desired profit is 40. Desired, the fixed cost is 17,500 divided by 0.25. So 40,000 divided by 17,000 is 57,500 divided by 0.25. This 2,30,000. So if you earn a if you make a sales of 2,30,000, you'll get the profit of 40,000. We'll cross verify. 2,30,000 into 0.25 is PV ratio. We'll get the contribution as 57,500 minus the fixed cost 17,500. We'll get 40,000. Simple. Please copy this. We'll see next requirement. I guess margin of safety. That is also easy. What is the fourth requirement? Margin of safety if the profit is 50,000. So margin of safety. So these are all formulas related to marginal costing, which you should not buy it, should be in your tongue. Everything should come out of your mouth immediately. Once margin of safety, you should tell the formula, profit by PV ratio. If you're telling this one, what is that, BEP, you should tell fixed cost by PV ratio. You should be that much accurate and fast in these things. So margin of safety is 2 lakh. Please copy down. And the last one, sorry, oh, fourth one, oh, we missed it. Profit when sales are 2 lakh 50. Okay, I'm sorry. So this is the fifth one, I guess. Then this is the fourth one. Profit when sales are 2 lakh 50. So 2 lakh 50 is my sales, they are telling. Obviously variable cost and contribution, and my fixed cost. Fixed cost we know that is 17,500, and my profit. So PV ratio is 25%, which means 2 lakh 50 into 25 is my contribution, which is 62,500. So the remaining will be variable cost. So 2 lakh 50 minus 187,500 minus 17,500, which is 45,000. Simple. So 4, 5 is done. Only 6th is pending. That is easy. If 25% is PV ratio, 75% is variable cost. So sales into 75. Both the ways you will get the, you will get the variable cost. One lakh 50. I'm sorry, this looks different. One lakh 50 into 75%. 1 lakh 70 into 75% will be my variable cost. So 1 lakh 50 into 75 is 112,500. If you can see, we did the same here also. Here also you can write the same thing, 112,500, and 1 lakh 70 into 0.75 is 127,500. Okay, so by this we have done question number 1. Simple. Next we'll see the second question. B Limited has a factory which manufactures a product whose sales have declined to 40,000. So currently the sales is at 40,000. Special purpose machinery is employed to make a product and there is no hope of using this for any other person. So other than this purpose, it is scrapped. So the estimated useful life of the factory plant is 5 years and sales should continue at the same level for the whole period. Variable cost is expected at 20,000. Fixed cost is 15,000, including depreciation of 7,000. So there is no requirement of separately to charge the depreciation. All sales and expenses incurred at the end of the year. If the factory is sold, lock, stock and barrel, which means they're locking it, giving the stock and everything, they may get 30,000. So immediately if they are saying, they may get 30,000. On the other hand, if it is operated for 5 years, 40,000 is maybe the residual value. So presuming 10% as the cost of capital, you are required to advise whether it will be appropriate to operate the factory or close it down immediately. Present value for 5 years is cumulative discounting rate is 3.791 and the present value for rupee 1 received after 5 years at 10% is 0.62. So here now we have to make a decision whether we should sell immediately or run the business. To run the business, we should estimate the cash flow, how much cash flow will be earning per year, and then discount everything to year 1. So we'll get an amount and compare with the selling value, which is more. If selling is good, sell it off. If running is good, run the business. Simple. Okay. So second one. So if you are running the business, my sales is 40,000, my variable cost is 20,000, my fixed cost including depreciation. So I'll make it two things. So fixed cost and depreciation 7,000. Okay. Is there any other cost associated? So 40, 20, 15. Okay. So the answer is 5,000, I guess. 15,000, 5, yeah. 5,000. Next. So if you are running the business for 5 years, you'll get 5,000 for 5 years and a scrap value at the end of the 5th year, that is 4. So this I can multiply it cumulative value, which is 3.791, because we'll be getting every year. So 4,000 you'll get at the end of 5th year, that is 62. Just add it up, both the things, and compare with the actual selling cost. Now 3.791 into 5,000, which is 18,955. 4,000 into 0.62, which is 2480, plus 18,955, which is 21,435. So if you're running the business at present, the value of the receipt is 21,435. If you're selling it as it is, you'll get 30,000. What you will do? Obviously you'll sell the business, because you're getting 8,500 rupees extra if you're selling it now only. So that is the thing. So in this question I have calculated the profit, which is 5k, then discounted every 5 years profit to current year with the help of the discounting factor. So why it is 3.791 means it is a discounting factor of all the 5 years at the rate of 10%. Okay, if you are confused, I'll do manually how they calculated this. Okay, year 1 you will receive 5, year 2 you will receive 5, 3, 4 and 5. Okay, so every year you will receive 5,000. Okay, but this 5,000 will not be 5,000 at the end of the first year, second year, third year. So there will be a discounting rate. So the discounting rate is 1 divided by 1.1. So it is 0.909. Here it is 0.826, 0.753, sorry 751. Here is 0.646830. Here it is 0.621. If you multiply all this, you will definitely get 18,955. If you multiply and add all this, you will get 18,995. At the end of 6th year, you will get a scrap value, that is 4,000, which is 0.621. That also you will get, that will be 2480, and totally you will get 21,435. So that is the logic for, if you add all this, wait, if you add all these numbers, you will get 3.791. So that is the thing that they had given already in the question. So now our ultimate answer is sell the business, because you will be earning 8,500 extra. Understood? Hope you understood. Just copy this. So this is the income statement, then the cumulative value, then the comparison. So I'll write the conclusion here. Conclusion: if we sell the business now, we get 30,000, but So please do copy this. So this is the first scenario. I'll write it as scenario 1. Scenario 1. In scenario 1 we have a profit of 3000 rupees. In scenario 2 we have a profit of 5000 rupees. Units. So can we start doing this? Yes. So question number 4th. First we'll find out the contribution. So particulars A and B. So sales price, then the VC. So we have direct material, direct labor, variable overhead. Okay. So what is the sale price? 20.5 and 15.5. So 20.5 So please copy scenario 1. So while revising, you have to revise either question number 3 or question number 4, not both, because both the things are same, the concept is same. So you can skip one question there. Let's go to the next question. So second is done. So question number 1, 2, 3, 4 is done. Now we'll go to question number 5. A very interesting question. See, if labor cost and material cost are likely to go up by 10 and 5% respectively per unit, what is the percentage increase necessary in the selling price to keep the PV ratio 20% as before, assuming that the ratio between material and labor is 3.2, variable overhead is nil. So they are telling that now we have material and labor in the combination of 3:2 and the PV ratio is 20%. Now the labor cost is increasing by 10%, the material cost is also increasing by 5%. Now we have to find the increase in selling price to make the PV ratio same, that is 20%. So that is the requirement. So I'm telling once again, current our PV ratio is 20%. The combination is 3:2, material and labor. Now the price is increasing, of labor 10%, material 5%, but still they require the PV ratio should be same. If the variable cost is increasing and the PV ratio should be same, obviously we should increase the selling price here. So that is the thing they are doing here. So we have to find the selling price. What is the percentage increase in the selling price? So simple, we'll try it off. So currently we will take the value as the value of SP is X. Okay. So currently direct material, direct labor. Okay, it will be, I'll take direct material as M. So what is the ratio? Material labor 3M. So 3M plus 2L. Okay. So if it is, now it is increased part now. So DM is increased by 1.05. So 5%. So DM, DL. So DM is 3M into 1.05 because it is increased by 5% and here it is increased by 10%. So it is 3.05 and 2 into 10, 2.2. So it is 5.25. Okay. I'm sorry, this is 3.15, 3 into 0.5, yes, 3 into 1.05 is 3.15, so I'm sorry, it is 5.35, 5.35, it has increased. Earlier it was only 5, because 3 plus 2, 5. Okay, how much is the increase here? 5.35 minus 5 divided by 5. So this is the answer. So 5.35 minus 5 0.35 divided by 5 into 100, which is, so we have to increase the selling price by 7%. Simple. Cost is increased by 0.35. That is the reason we have to increase the price by 7%. Very simple question now. Please try. So here I have taken as x. Okay, so instead of writing m and l, I can take it as x only. X, so 5x. Here also it will be x, 5.35x. So there is an increase of 0.35. That's it. Simple. Okay. Next we'll start with the 6th question. So hope you have written this. Now I'll go to the 6th question. 6th question is a very big question. So this may be asked in examination. Please mark it as important. See, they have given revenue 1 crore, fixed cost 17 lakh and variable cost 82 lakh. Variable cost change with respect to the number of units sold. Please be careful. Which means if you're selling more units, variable cost also will change automatically. That is the thing. Now, compute the budget operating income for each of the following deviations. So we have to calculate the operating income from the original budget. So first we'll prepare the budgeted income now. So budgeted income. Revenue is 1 CR, 1 followed by 7 zeros. Like this VC, variable cost is 82 lakhs. So my contribution is 18 lakh. My fixed cost is 17 lakh. My net profit is 1 lakh. This is the budgeted income. Now what are they asking? Now we have to test each one of the scenarios. We have 8 scenarios. First, they're telling that 10% increase in the contribution margin, holding revenues constant. So which means variable cost is coming down because revenue is constant, but your contribution is increasing, means obviously your variable cost has come down. So try it out. So revenue will be 1 crore. What is our contribution now? 18 lakh. Increase it by 10%, which means 19 lakh 80. So the balancing figure will be variable cost. Then decrease the fixed cost of 17 lakh and your profit will be 1 lakh 80. Simple. Please try. So first scenario, 10% increase in contribution margin. Am I right? So sales is constant, so I can't change. 1 followed by 7 zeros. VC I have to check, but contribution increased by 10%. So 18 lakh into 10% plus 10%, so it is 19 lakh 80. This is 18 lakh plus 10%. If you take in your calci 18 lakhs plus 10%, you will get the same thing. So the balancing figure is my VC. How much is it? 10 lakh 20. 10 lakh 80 lakh 20. So fixed will be fixed every time unless told. So here contribution is profit is 1,80,000. So this is the answer for our first scenario. Okay, so we'll see the next scenario, that is a 10% decrease in the contribution margin. Holding revenue is constant, which means now variable cost is increasing. So simple. Second scenario, revenue 1 followed by 7 zeros. VC will be increasing. Now contribution will be reduced by 10%. So take in your calculation 18 lakh minus 10%, 16 lakh 20, I guess 16 lakh 20. Balancing figure is my variable cost, that is 83 lakh 80. Now we'll have a loss. Fixed cost 17 lakh, loss of 80,000 loss. Second scenario done. I'll give 2 minutes. Okay, now we'll go to the third scenario. What is the third scenario? Increase in 5% of fixed cost, and then we have the fourth scenario. Fifth 5% is increased in 5% increase in and decrease in fixed cost. Simple. I'll do it together itself. So third and fourth is easy. Third. So I'm simply doing a layman job here. So fixed 10% increase. So it is 17 lakh here into 1.1. It is 18 lakh 70. Again loss of 70. Simple. So I'll just write it down. Write it down along with me because these are simple things. Revenue 1 CR minus VC of 82 lakh, 18 lakh of contribution, minus fixed cost is reduced by 10%, so it will be, so 17 lakh minus 10%, it is 15 lakh 30. So 15 lakh, so 18 lakh minus 15 lakh 30, just 18 lakh minus 15 lakh 2 lakh 70. So both the things are done, fixed asset. Now we'll go to these two. See, this one you should be careful. Variable cost change with the units of production. So if units sold is increased, then you should also increase the corresponding variable cost also. So 8% is increased now. So this is my fifth scenario. Revenue is increasing by 8%, which means 1 crore 8 lakh. then corresponding VC also should be increased. 82 into 1.08, which is 88 lakh 56,000. So my net effect would be 56,000, which is 19 lakh 44,000. So contribution is 19 lakh 44,000 minus the fixed cost is 18 lakh. Is it 18 lakh? I'm sorry, it is 17 lakh, sorry. $2,44,000. Now the sixth scenario is decrease in units. Okay, revenue, it will be 92 because 8% is reduced. So here 82 lakh will be reduced by 8%, which is 7544. Okay, next that is VC. Now the contribution, so 92 lakh minus 7544,000, so 1656. 17 lakh is my fixed cost. So 44 is my loss. So it's kind of labor work, but we don't have any choice here. So that is the thing. So we have covered all the 6 scenarios. So please copy 5th one. So what is the 7? See, 7 scenario, 10% increase in the fixed cost, 10% increase in the unit sold. We have to consider both the things. Please be careful here. So 7th scenario. So my fixed cost is 17 lakh, they are doing 10% increase, which means 18 lakh 70. Just note down all the things, okay? Then they are telling 10% in units sold. So here it will be 1 crore 10 lakh. Here it will be 82 into 1.1 because 10% is increase. So it is 90 lakh 20,000. So what is my contribution? 19 lakh 80 minus 18 lakh 70. So 1 lakh 10,000 is my profit. Please be informed here because 3 things have changed at a time. If the units is sold, variable cost will change because they have given in the question itself. If you can see this line, so I'll just see if you can see here. I'll highlight this. So this is more important here. Okay. So that is the thing. Now we'll try out with the 8th scenario, last and final. By this we will be completing this very big question. Revenue, VC, contribution. Then we have fixed cost. Then we have profit. First question, there is a 5% increase in the fixed cost, which means 17 lakh 85 because 5% increase. done, and there is still 5% decrease in the variable cost. So variable cost is decreased, not the revenue here. So revenue will be same. So 82 lakh minus 5% in your calci, which will be 77,90,000. So the remainder would be 22 lakh 10,000 minus 17,85,000, which will be 22 10,000 minus 17,85,000 will be 4,25,000. 4,25,000. So that is the thing. So we have done all the required elements in this question. So please copy. Plus copy the 7th scenario. So next we'll see the 7th question now. So 7th, what are they asking here? So you are given the following corporate budget data for the next year. Okay, they are giving the budget data. The projected capacity of the plant when sold would return 70,000 in sales income. The variable cost is 30, fixed cost is 20. So we have to find the break-even point, we have to find the profit or loss on sales, and we have to find the desired sales to earn a net profit. So simple as usual, our routine questions on marginal costing. So 7th, so first we will prepare an income statement to find out the PV ratio and all those things. Sales minus the variable cost. So if you're doing any question on marginal costing, plus please try to do the income statement at the beginning, so it will be helpful for everything. So to calculate the PV ratio, maybe the fixed cost, the profit, etc. So profit, sales is 70, variable cost is 30 and fixed cost is 20. 70, 30, 20, it is 40,000, and here it is 20,000. So now now see, it is easy to find the PV ratio. Contribution is 40 divided by 70 into 100. 40,000 divided by 70,000 into 100. So it is 57.143 percentage. Okay. So now we have to find the break-even point. So break-even point, what is the formula? Break-even point. So it is fixed cost by PV ratio. So what is my fixed cost? 20,000 divided by 57.143. How much is that? 20,000 divided by 57. 20,000 divided by 57.143. So I'll round it out to 35,000. So I'll get around 35,000. 34,999. I'll round it up to 35. Now we'll have to find the profit or loss to this business if sales. So simple. So profit slash loss. So I'll take two scenarios, A and B. Sales, VC, contribution, the fixed cost. Fixed cost is 20,000 everywhere. No one can change that. So my sales is 49,000, 49,000, 28,000. So my PV ratio is 57.143. So 49,000 into, so I'll get rounded up to 28,000 here. So minus 20, it is 8,000. Okay. Next, in this scenario, so 49 minus 20, it is 21. So 28,000 into 0.143, I'll get 16,000. So 4,000. 4,000 is the loss here. So by this we have concluded the second part also. So with the help of PV ratio we calculated all this. Next I'll solve the third one and give time to write. So it is desired sales, simple. So desired sales. So the formula is desired profit or income plus fixed cost divided by the PV ratio. Okay, desired profit is 28,000. So he is desiring to have a profit of 20 plus fixed cost. You'll get the desired contribution divided by PV ratio. We'll get it. So you'll get the answer as 20 plus 28 is 48 divided by 0.57143 is 84,000 rounded off. So we'll round it off to 84,000. Simple. So please copy both the things. Next we'll see the 8th question. Eighth question tells that a company budgets for a production of 1,50,000 units, variable cost, fixed cost, selling price. The company fixes a selling price that it should fetch 15% on cost. So they're telling that the return should be 15% on cost. Okay, what is the break-even point? What is the PV ratio? If it reduces the selling price by 5%, how the revised selling price affect the break-even point and the PV ratio? So it will obviously have an impact, whether it may be reduced or increased, that we should check. If a profit increase of 10% is desired more than the budget, what should be the sales at reduced prices? The selling price should be decreased, but what is the sales amount, that we should check. Okay, we'll start. First and foremost thing, we have to prepare the budgeted income. I mean the sales income statement. Sales that we have to find. So we'll do it like this. First we'll calculate the sales, because we don't know the sales, no? Cost plus first is variable cost. So what is the variable cost? 14 per units, 1,50,000. 1,50,000 into 14. How much is that? 1,50,000 into 14, which is 21 lakh. Okay. Fixed cost is 3 rupees, 2 rupees, I guess. 2, yeah. So 3 lakh. So total is 24 lakh. Now they're telling the profit should be 15%. 15% on cost. So 24 lakh into 15%. 3,60,000. Total comes to 27,60,000. So I'll find out the price now. Selling price will be 27,60,000 divided by 1,50,000, which is 18.4. So that is the selling price. So we have the selling price. Now we have to find the break-even point. What is the formula for break-even point? Now we have all these things. Now we'll prepare an income statement. Income statement is exactly reverse of that. So in order to find PV ratio, we'll have this. Okay, 27,60,000 is my sales. Variable cost is 21 lakh. So my remaining is 6,60,000 minus fixed cost is, how much is the fixed cost? 3 lakh. So 3 lakh is my fixed cost. Then my profit is 3,60,000. But PV ratio we can calculate here only. No, PV ratio is 6,60,000 divided by 2760. 6,60,000 divided by 2760. 23.91. 23.91 is my PV ratio. So what have they asked? PV ratio we have found out break-even point. Break-even point is nothing but fixed cost by PV ratio. So it is 3 lakh divided by what? So it is 12,54,705. This is my break-even point. Okay, now they're telling that it will reduce the selling price by 5%. What is the revised selling price? Okay, and effect on BEP and profit volume. So just they're simply reducing the price, that's all. So I'll do revised selling price. Which means 18.4 minus 5% of 18.4. So it is 18.4 minus 0.92. So 18.4 minus 5%. It is 17.48. It is 17.48. So using this, now we have to calculate the new income statement. Then we'll find out the PV ratios and all. So sales, so it is 17.48 into 1,50,000, which is 2622. VC will be same because we are not making any changes here. So there, what are they asking? Break-even point and profit volume. So okay, PV ratio will definitely change here. PV is 6,22,000 divided by 2622. So 6,22,000 divided by 2622,000 into 100. It is, see, now it is increasing 23.722. There is an increase in PV ratio. Now we'll check whether if there is any effect in the BEP. BEP, fixed cost will change, will not change, I'm sorry. So divided by 23.722. So 3 lakh divided by 23.722. So it is 12,64,638. So is there any change? 12 lakh 54, 12 lakh 64. There is an increase in about 10,000. So that is the change here. Simple. That is the thing. Okay. Now, if a profit increase of 10% is desired more than the budget, what should be the sales at the reduced prices? Simple. They are asking more of 10% profit from the budget. So what is my budget? 3,60,000, I guess. Yeah. So desired sales is 3,60,000 plus 10%. This is my desired profit. Fixed will not change at any time. So revised, we have to take revised PV ratio because they are telling that revised cost. That's the reason. Reverse selling price. So 3,60,000 into 1.1. 3,96,000. I am taking into consideration the 10% increase plus 3 lakhs. It is 6,96,000 divided by 0.23722. So my sale should be 29,33,985. This is the thing. So I'll explain once again from the top to make you understand. So this part is easy. I know my variable cost, I know my fixed cost, and they're telling profit should be 15% of cost. I found out the selling price. So my total sales is 27,60,000 divided by 1,50,000. I got 18.4. So this is clear for everyone, I hope. Now I prepared an income statement. Nothing exact reverse of the previous calculation. In order to find out my PV ratio. Understood? PV ratio, fixed cost, everything. So now BEP is, I know my fixed cost is 3 lakh, I'll divide it by PV ratio, I got my BEP. Now in the question they are telling that there will be a revised selling price. So revised selling price is nothing but reduce 5% from the existing selling price. So I got 17.48. Okay. Using that 17.48, I prepared a new income statement, and using that income statement, I prepared a new PV ratio as well as the BEP. So that is the thing here, and they are asking me to calculate the sales at the revised selling price. Revised selling price means I have to take the second one, not the budgeted one, new PV ratio. Using that PV ratio, I have calculated the sales also. So please copy from the beginning. So this is not so complicated, but yeah, to some extent. Please copy. Okay, let's go to the next question. So next one is based on the joint costing. Okay, joint cost. Please be careful. A company is producing two products A and B from a joint manufacturing process. So there is a one joint process. In that two outcome will come A and B. So the joint cost are 2 lakh. So the total joint cost is 2 lakh, and it has been given a production of 1 lakh kilogram of A, which has a selling price of 1, and 2 lakh kilograms of B, which has a selling price of 1.5. So you can distribute the joint cost at the sale at split off point. The company is considering a proposal for product A into new product Z, which sells at 3 rupees. The processing cost is 1,75,000, converting 1 lakh kilograms of A. You are required to advise the company about acceptance or rejection of the above proposal. So first we will see at split off point how much profit is it making. Then after that, how much is it making. We will find which is better. We will do that only. So before that, we have to distribute the joint cost based on sale at split off point. So this is the 9th question. Okay. So 9th question, first two product is there, A, okay, I'm sorry, one joint process, but we have two outputs, A and B. This is 1 lakh kilo, that is 2 lakh kilo. Yeah, at 1 rupee, at 1.5 rupee. But A can further process to Z, but the cost is 1,75,000. But here it can sell at 3 rupees. So this is the question. So here we have spent 2 lakh. So first we will distribution of joint cost. Distribution of joint cost based on sales at split off point. Okay, first we will find the sales A, B. So 1 lakh into 1, 2 lakh into 1.5, I guess. Yes, so it is 1 lakh, it is 3 lakh, so total 4 lakh. So ratio is 1:3. So joint cost for A and B. A it will be 2 lakh into 1/4, which is 50,000. Here it is 2 lakh into 3/4, it is 1,50,000. Now if suppose you will sell sale of A at split off point, the sale value is 1 lakh, I guess. So it can be sold at 1 rupee, which means sales 1 lakh into 1, which means you will get 1 lakh rupees. Cost is 50,000. Okay, so this is one thing. Now if processed, okay, it will be sold at 3 rupees. So it will be 3 lakh, because it is 1 lakh into 3. Then incremental cost, which is 1,75,000. Then the joint cost, which is 50,000. Subtract all this. So it is 3 lakh minus 1,75,000 minus 50,000. We will get a revenue of 75,000. So what will you do? So if you are selling at split off point, we will get 50,000, and if you are selling at after split off point or further processing, you will get 75,000. Which will you do? Further process. So that is the thing. Please copy from here. So this chart will help you understand the process, exact process, what is happening. So now we'll see the next question. Question number 10. So this one is referring to cost sheet and marginal costing, both the things. So we should be careful here. So the following information regarding the operation of 2022 has been made available from the records of the B and company. So they have sales, direct material used, labor, factory, fixed manufacturing overhead, fixed selling and distribution expense, gross profit, net loss. So we have to find the variable selling and admin expenses, contribution, variable factory overhead, break-even point, factory cost of goods sold. Okay, we have to find all those things. For doing all these things, first we have to prepare a cost sheet. Then only we can calculate all these things. So question number 10. First, direct material, direct labor. So do we have direct expense? No, so we can close it here. This is prime cost. Prime cost. Direct material is 40, 15, 55,000. Okay. Next, for this we'll add factory overhead. It may be fixed, it may be variable. For this, next we'll add admin. If there is admin or admin overhead, it may be fixed, it may be variable. And at last we will arrive at the total cost, profit or loss. Then we will have the sales here. Sales they have given 1 lakh and loss at a loss, so it means it will be 105. Okay. Next, fixed manufacturing overhead is 20,000. Okay, and fixed selling is 10,000. Admin or selling, so 10,000. So we have a cost of 1,50,000. See, we can find the factory cost here. Factory cost with the help of GP. So sales minus GP will give you factory cost. So in the P&L, I mean in the trading profit and loss account, you will have sales here, closing stock here, opening stock, purchases. The amount which you get here is the GP. The amount which you get down is net profit or loss. So now I have my sales of 1 lakh and GP of 20, which means my factory cost is 80,000. Okay. So here it is 75 plus 5, 80. Understood? Simple. Now here it will be 15,000, balancing figure. So now we have found out every expenses. See, simple. With the help of GP, I am finding out factory variable overhead. How? Sales minus gross profit is my factory cost. So 1 lakh minus 20 is my 80,000 is my factory cost. But I have 75,000 here. That is 55 of prime cost and 20,000 of fixed overhead. So my variable overhead is 5,000. So now next here the balancing figure will be variable selling and distribution overhead. Okay. Now we have prepared the cost sheet, but by this we will answer two things: variable selling and distribution overhead, variable factory overhead. Two things is answered. So you can make point number 1 distribution this one, point number 3 variable factory overhead is this much. So now the main thing comes, and factory cost of goods sold is 80,000. So this one. So factory cost of goods sold is that if it is cost of goods sold, it is 1,05,000. So it will be here. So now we have to find break even and the contribution. For that we have to prepare the same thing in the marginal income statement. So income statement. First we have the sales, which is 1 lakh. Next we will add all the variable expenses in here only. Okay, first we have material labor. So I'll change my color pen. So I'll mark all the variable expenses. This is variable cost, this is variable cost, so this is variable cost, and finally this is variable cost. If you add all this, 15 plus 5, 20 plus 55, 75,000. 75,000 is my variable cost, so 25,000 is my contribution. What about the fixed cost? Remaining is fixed cost, that I will see. So here 20, here 10, so total 30. See, 5,000 is negative loss, so it is matching. Understood? Easy. Simple. I prepared the cost sheet first, filled all the numbers, then I prepared the income statement as per marginal costing. So by this, can I calculate PV ratio? PV ratio is simple, 25 by 1 lakh, 25%. Okay. Next, what did they ask? Contribution margin we have calculated, break even point. So BEP is simple, fixed cost by PV ratio. BEP is fixed cost by PV ratio. 30,000 divided by 0.25, which is 1 lakh 20, is my BEP. Simple and done. So please be careful. First prepare the cost sheet. So next we will see the next question, that is question number 11. So question number 11, they are telling that audio manufacturing company finds that it costs 6.25 to make a component P273Q and the same is available in the market at 5.75 each. With an assurance of continued supply, the breakdown cost is 6.25. For 6.25 they have given this breakdown, but in this 6.25 I can ignore this. So 0.5. So this depreciation we can ignore because since it is a fixed cost, it has to be ignored. So my actual cost is 5. In market, I will be getting at 5.75. Which is better? Make it in home or make it in the company, that is better. Should we make or buy? Make it, because we have to not consider the depreciation here. What would be your decision if the supplier offered a component at 4.85? So 4.85 is less than 5, then you should go out or buy it. If he is giving a assurance that he will supply in time and the quality also, that also should be taken into consideration. So this you can try it out, no issues. Now question number 12. So question number 12, they are telling it is related to the previous only, same topic. Auto Parts Limited has an annual production of 90,000 units. Okay, its component structure is given below. Material, labor, in labor 25% is fixed, which means from 180 remove 25%, 45 rupees. So 45, so minus 45, this will be fixed. Okay, variable and fixed. Okay, done. The purchase manager has an offer from a supplier who is ready to supply at 540. Should the component be purchased? Okay, first I will break down this 675 into fixed and variable, then we will analyze. So variable, I will add only variable cost. Okay, 270 plus here 190, and from this I will deduct 45. So 180 minus 45 is 135. So this is my variable cost, and my fixed cost is 45 plus 135, which is 180. So from 675, 270 plus 90 plus 135. So 495 is my variable cost and 180 is my fixed cost. I'm sorry. So 495 plus 180, it is 675. So as I told in the previous question, you should never consider fixed cost, because if you produce in also, if you produce out also, if you are buying from outside, if you are producing inside also, the cost will be same. There is no difference in the fixed cost. So that's the reason while making decision we have to take only the variable cost. See, in the market they are providing at 540, and I have to incur the variable fixed cost inside also if a producer not produce. That's the reason I will make it in-house, because variable cost is 495. Next, assume that the resources now used are used to produce new products. So now they are using new products, so which means fixed component is occupied in some other product, and you will be getting at a price of 485. So 485 is less than 495, since I will tell produce or purchase it from outside. In the latter case, material price is 200 per unit. Okay, they are telling the new thing now. Instead of 270, it is 200. 90,000 of the product can be produced the same cost basis as above for labor and expenses. Discuss whether it would be advisable to divert the resources to manufacture a new product on footing that component presently is being produced would be being produced purchased from the market. So he is telling that, see, now we came to the conclusion that 485 will get in the market, we will go to the market and purchase it off. But now they are telling that we will get the component for 200. So I will add the component of cost of 200. Okay, so from this 495 I will minus 70 rupees, because material cost is reduced by 70. So it is better to produce inside only, because you are getting a component at 70 rupees less. So which means your net cost is 425. Purchase it at produce it at 425 only. Why to buy at 485? You will be at a profit of 60 rupees. That is the thing. So I have given the explanation. Please try to solve it. So in the first scenario, we'll produce inside, because our net cost is 495, because we'll consider only the variable cost, not the fixed cost. In the second scenario, the fixed cost of the fixed asset is being occupied by another product, so there is no tension for that. We are only concerned about the variable cost. So variable cost, if we are getting 495. If we purchase outside, it is 485. We are at a profit of 10 rupees. That's the reason we will produce. Next, so then there is a second case scenario that they are telling that we can produce the product as 200 rupees, not 270. Then also you will produce inside or buy it from outside. If you buy it from outside, it will be 485. If you produce inside, it is 495. But there is a reduction in price of the material, which means 70 rupees. So earlier it was 270, now it is 200. So 495 minus 70, my net cost is 425. If you produce outside, it is 485. You will be at a profit of 60 rupees. Understood? So that is the thing here. So question number 12 done. So you can write down the notes based on the explanation. Okay. Now question number 13. See, if you see question number 13, they are asking you to calculate the BEP for each business and which business is likely to earn more profit when there is heavy demand. So calculate the BEP for both the things. So first you will have to calculate the BEP. For BEP we need PV ratio. PV ratio you can find. We have sales, you have variable cost. Find it out. BEP. BEP. We will find it out. And next we have to find which will make greater profit in heavy demand. If there is heavy demand, which will make profit when which is having lower which is having higher variable cost, it will make more profit because fixed cost is less now. So if you are making heavy demand, you will get heavy contribution, more contribution, then you will earn more profit. So if there is low demand, which is having fixed cost more, it will earn more profit. So that is the thing. So 13 you can answer. So 14, so the availability of material is limited to 8000 kg. Demand they have given. Variable cost of making, purchase price per unit, kgs. Determine whether the company should make or buy. So just in this question, see, multiply this and this, you will get the making cost. Multiply this and this if you are purchasing from outside. Which is less? Go for it. And kgs is that how many units of A each is required. So it is better to go for these two. Compare these two, which is easy. Do see, this is in all the scenarios making is better because the prices are external market is more. So 13, 14 done. Now the last question for the day, question number 15. So what are they telling? So this question is same in marginal costing also. We have the same question. A company manufactures a product and sells at 3000. Okay, an increase in 17% in the cost of materials, 20% in the cost of labor is anticipated. The increased cost in relation to the present sale price would cause a 25% decrease in the amount of present profit. At present, the material cost is 50, 20 and 30% of sales. Okay, so we have to analyze this question. First, they are telling that the price is 3000 and they are telling that at present the material cost is 50, wages is 20, overhead is 30% of sales, cost of sales. But have they given cost of sales in this question? No. That is the reason we will consider or we will assume that the selling price is only the cost price in this particular question. If in exam, if they are given profit, remove the profit and find the sales. But in this particular question, they have not given any information with relation to profit. That is the reason I am making an assumption. I will read the assumption. In exam, if they give this question, please read the assumption that in this question we are not able to find the profit. That is the reason I am making an assumption that 3000 is my selling price or the cost. Cost and selling price is same. Okay, that is one part. We have taken care of that. Now they are telling that there is an increase in material cost and the labor cost, 17% and 20% respectively. Okay, that is one thing. So that is my second point here. my third point is that the increased cost in relation to the present sale price would cause at 25% decrease in amount of the present gross profit. So they are telling that the increased selling price would reduce the current gross profit by 25%. So this is the third point here. So we'll analyze the points one second. First point, I am making an assumption that the 3000 is the cost of sales, and the cost I'll divide the material, overhead and labor. That is my first assumption. My second point is that they're telling that there is an increase in cost of material and labor, and the third point is that in this there is a 25% decrease because of the increase. Now what are they asking? They are asking to prepare a statement of profit and loss for the unit at present. So that is easy. Now compute a new selling price to produce the same percentage of profit. They are telling if the price is decreased by 25, you have to, if the gross profit is decreased by 25%, you have to find a price which helps us to get the current profit only. So we'll solve one by one. First point, current profit and loss account. Selling price is 3, direct material is 50%, I guess, so 1500. So this is an assumption, please write it in exam. 20% is wages. Okay, variable overhead is 30%, which is 900, so 3000. So net profit, net loss 0. Now change the scenario. DM, which means direct material, is increased by 17%. So 1500 into plus 1500 into 17%. Direct labor is 600 plus 600 into 20%. So variable overhead, there is no increase, so variable overhead 900 only. So 600 plus 20%, 720. 1500 plus 17%, 1755. Add it up, plus 7. So this is 3375 is my new cost, but this cost will reduce the GP by 25%, which means this is 75% of cost, because of this increased price my profit will be reduced by 25%. In order to match that, I have to increase the selling price by 25%. So 3375 into 100 divided by 75. So my price will be 4500. So I'll explain the last point if you are confused. So this 3375 which I got will reduce the profit by 25%. In order to match that, I have to increase the selling price by 25%. No, that is the thing. So by this we have completed the applications of marginal costing in short-term decision making, all questions. So please copy. So thank you for the day. Next we will see in the next class, next session.